are professionals. We are impact-driven. We are CFA Society Nigeria, a member society of the CFA Institute Global Network of Societies. Our mission is to promote the highest standard of practice in the Nigerian financial services industry and provide a vibrant community for our members. The CFA Charter signals the holders' commitment to professional excellence. As thought leaders, we collaborate with stakeholders to ensure adherence to ethical standards, better education for professionals, and to build market integrity. We are the leading voice for advocacy in the finance and investment industry in Nigeria. To partner with us or become our member, visit us at cfasocietynг.org for more details. CFA Society Nigeria, making finance a force for good.
Good morning, everyone. I'd like to welcome everyone to the first in the series of breakfast knowledge sharing sessions from CFA Society Nigeria. I would like to invite the chair of the Board of Governors of CFA Society Nigeria and the president of the society to give our opening remarks.
Thank you very much, Yemi. Good morning, everyone. My name is Ibukun Oyedeji. I'm the president of the CFA Society Nigeria, for those that are not our members. I'm really excited to welcome all of you to our very first breakfast knowledge session of the year, with a topic on the tax implication of the Finance Act of 2021 on various sectors, a tailwind or a headwind. As we all know, the Finance Act was signed into law in last year, 2021, and it actually amends about 13 different fiscal legislations and tax. And today, I think on this platform is very important. We thought that it was very important for us to invite a tax expert to come and talk to us on the matters that concern us. How do we apply these rules? What are the implications on us? Either in our individual roles or in the corporate world or in some clients we're advising, so that we can really be able to add value to our customers or the firms, organizations we work with. Today, I'm very pleased to welcome someone to our platform for the very first time, someone I consider my sister and friend, who is an expert in tax matters as our guest speaker. Nika James is a partner tax, regulatory, and people services at KPMG Nigeria, and she'll be taking us through the implications of this act on the various aspects of the economy. As a society, events like this, we usually use it to help our members learn more about the pressing issues in the market. We also use it to introduce experts on our platform to help us gather enough knowledge and skills to be able to apply this knowledge in our various roles. And this is part of our mission as a society to promote the highest standards of ethics, education, and investment practice in Nigeria. I'd want to say a very big thank you to the programming committee of the society for playing a big role in organizing this event. Last year, we had an event on the petroleum industry bill, which was extremely exciting. I mean, for most of us who had been looking forward to that bill, we know what has happened in terms of the implementation of that now. But today, I also look with such level of enthusiasm to today's speaker as she takes us through this session. So I'd want to ask all of you to please sit back, engage the speaker, and enjoy the session. Let me formally introduce Nika James. Nika James is a partner, like I said earlier, is a partner tax, regulatory, and people services at KPMG Nigeria. Her specialties include banks and other financial services, PE funds, regulatory intervention, tax advisory, and tax management consulting. She has over 20 years experience providing tax advisory services and compliance to multinationals, local clients in banking industry and other industries. Her wide range of experience makes her qualified to be able to take this topic with us, as she has worked on various areas that include tax advisory, like I said, implementation of cross-border schemes, mergers and acquisition, compliance check and audit, reorganization, recapitalization of organization, business restructuring. So we're working closely with various clients around the tax and internal audit function, and overall reporting, ensuring that they're in compliance with the tax and reporting with governments. She also works closely with regulators and trade associations. So I'm aware she works with FIRS, she works with CBN, NICOM, PENCOM, and even the Bankers Committee. Today, I'd want to welcome Nike on our platform. Nike, thank you for taking the invitation to speak to us on today's topic. And I'll now hand over to you to begin the session. Welcome, Nike.
Thank you very much, Ibukun, for the very, very warm welcome. I am truly grateful for that. And good morning, everyone. It's really a pleasure to be here with you this morning at your knowledge sharing session, and to discuss the very topical issue of the tax implications of the Finance Act 2021, and then to address the issue of whether it is a tailwind or a headwind for the Nigerian economy. So as we move on to the next slide to share the outline, over the course of the next 45 to 50 minutes or so, I'll be taking us through a brief overview of the Nigerian economic environment and the key economic drivers and objectives of the Finance Act. And this is to help us dissect the issue of whether it is a tailwind or a headwind for the economy. This will be followed by a deep dive into the tax implications of the Finance Act, for the various sectors that we have in the economy, both on a sectoral and on a general analysis basis. That's how we'll do it. We will conclude with our thoughts on the action points that you, our audience, who are, managers of businesses or financial analysts advising your clients, what are the action steps or points you need to take away from this discussion? We'll also share with you our final word on the matter of the impact of the Finance Act on the economy. So we move on to the next slide, and I will proceed to share with you an overview of the Nigerian macroeconomic environment. Next slide, please. Okay, thank you. So it is imperative for me to, in starting this discussion on the Nigerian economic environment, to first say that we'll be focusing mainly on the Nigerian budget for 2022. I have a lot of statistics and analysis here, but in view of time, I'll use two key ones to actually facilitate this discussion. So I'll start by saying, when you look at the 2022 budget, it is imperative to note that it has been tagged the budget of economic growth and sustainability. And as many of you may recollect, the 2021 budget was tagged budget of economic recovery and resilience. So one of the big questions is, have we indeed moved from a resilience, from a recovery stage to one of growth and sustainability? In which case, we can then ask the question of whether the budget and its fiscal policies serve as a tailwind to spur further, economic growth. Now, to shed more light on this, I'll be discussing two of the key budget parameters and fiscal assumptions which are on this slide. The first is the budgeted GDP growth rate of 4.2% for 2022. Now, this is a welcome development if the Nigerian economy can indeed meet this projection and therefore sustain an increasing GDP growth that we have started to witness since the fourth quarter of 2022. Since the fourth quarter of 2020, sorry. So currently, the economy has experienced about four consecutive quarters of GDP growth since the pandemic-induced recession in 2020. And this is not counting the last quarter of 2021, because officially the statistics are not out. But we do have indications that in Q4, the economy actually grew by like 3.5%, which even though is a slight contraction when you compare to the previous quarter of Q3, where we had a growth rate of about 4%. But overall, it will imply that for 2021, the Nigerian economy actually grew about an average of like 3%. Now, if you measure, so we did a 3% in 2021, government is estimating a 4.2% for 2022. Now, if you measure that 2022 growth projections against the backdrop of projections from international bodies such as IMF, they have placed a conservative growth on the Nigerian economy of like 2.7% for 2022. So you would agree with me that if we indeed achieve a 4.2%, budgeted estimate, it will be like almost twice what the international estimate is. And it can be a confirmation that we have fully progressed from a recovery stage, and we are now into a growth and sustainability stage. The other thing is that such a sterling performance in 2022 would also serve as an indication that the 2022 budget and its accompanying fiscal instruments of the Finance Act 2021 have indeed helped to propel and boost the economy, and therefore have served as a tailwind, helping to propel the economy into further growth and sustainability. Now, please don't let's take this as a conclusion of the matter that the Finance Act is actually a boost and it serves as a tailwind, because I'd like to also discuss the other parameter of interest before we then try to get some synthesis on this. And the second parameter is actually to draw your attention to the actual budgeted revenue, expenditure, and resultant deficit that we have for the 2022 budget. Based on the budget, we have a burgeoning targeted budget of like 10.7 trillion, which is about 30% higher than the 2021 budget. We also have a projected expenditure of like 17 trillion, which far exceeds the revenues, as you can see, and creates a massive deficit of like 6.4 trillion. Again, this deficit is about 1 trillion higher than the budgeted deficit for 2021. And this leads to the big question of where will the money come from to generate these ambitious revenue projections and then to finance the massive deficits? From representations, we know that government has said taxes and borrowings have been pegged down as the major cash streams. Tax collection is expected to be used to boost revenue generation, and borrowings, both internal and external, have been targeted as funding the deficit. Now, I'm not an economist. I need to say that before I go to my next statement, but I would like to share with you a point of view from one of Nigeria's key economists, Dr. Ayo Teriba. And at a recent forum, in his words, he said this: government financial pronouncements that they need to coincide with our actual reality, and that for an economy that recently, recovered from recession, has suffered massive devaluation and is still recovering from the throes of COVID-19 pandemic, the expectation to increase tax revenue generation from an already overflogged economy is very unrealistic. These are very strong words, but I think you would agree that they serve as a pointer to the counterproductive impact that the government's budgetary and fiscal actions may have on the economy. It is also a note in the direction, it notes us in the direction that the Finance Act and similar policies that have higher revenue generation aspirations may eventually spur headwinds that can spiral the economy into a growth slowdown, and which is what we don't want. Now, we have seen two conflicting analyses of whether the fiscal policies are heading us towards a tailwind or a headwind. But before we further analyze on this issue, let us now examine the economic drivers and objectives of the Finance Act. So over to the next slide. Thank you. So as we would have noted, the passage of the Finance Act 2021 is a continuation of the fiscal policy reforms tradition that started with the Finance Act 2019. And this is the third Finance Act in a row. The FA 21, like we call it in short, amends over 10 Nigerian laws and statutes, and Ibuku helped us with that during our opening speech. And it also confirms that this is a return to an era of active fiscal supervision and directive. Now, just to remind us, let us take a step back in place. We will remember that the expectations of from when the Finance Act 2019, which is the first in the series, when it was issued, is that tax law amendments will spur the economy and aid government in achieving the annual budget. We will recollect that when the Nigerian economy went into recession in 2020, following the outbreak of COVID-19, the government, in a bid to combat the economic crisis, implemented macroeconomic policies that were focused on attracting investors, growing the economy, helping businesses stay afloat, and creating employment. This expectation and fiscal regime continued into the Finance Act 2020, which is the second in the series, where emphasis was then placed on improving efficiency in revenue collection and remittances, granting tax exemptions to ease the pressure on businesses rather than increasing taxes. But after the Nigerian economy had effectively exited recession, the government's macroeconomic focus shifted to improving revenue generation, especially the non-oil revenue. Now, this is the underlying basis for the tax revenue generation focus, and the reason why the Finance Act 2021 featured key changes that include increasing, existing tax rates, introducing new taxes, and so on. But of course, these changes have raised valid concerns of whether the act will spur the desired economic growth or it is counterproductive for an economy that recently exited recession. So I'd like to say at this stage that there are no easy answers to the question of the impact of the Finance Act on the economy, and perhaps only time will truly tell us. However, I'm hoping that each of you in the audience will be able to individually reach an opinion on this matter at the conclusion of this presentation. And we would also share with you our thoughts as well on this. So at this point, I would like to proceed now for us to do a deep dive examination of some of the key reforms introduced by Finance Act 2021 to help us better understand how it will affect, the businesses in various sectors. And we will be starting with the impact on the financial services industry. Thank you for that. Now, for the financial services industry, and in the first one I'm going to mention, it actually includes pretty much everyone, but I guess it's a financial instrument at the end of the day. I guess it will be right to say that the single major biggest announcement is that federal government has now rolled back partially the exemption of sale of shares from CGT. So going forward, any sales proceeds, of sale of shares that exceeds 100 million in any 12 calendar months will be liable to CGT at 10% on the gains from those disposal. Now, this is a big issue because over the last 30 years, we have had that sale of shares has been exempt from CGT, and we've all become used to it. And in a sense, overnight, we suddenly have those taxes back, and a lot of transactions, deals have been done, and projections, modeling on the basis that this is an instrument or sale of shares is exempt from tax. So it now questions the fundamentals into which so many transactions would have already been entered into on that basis. But the good news is that there are some exemptions also. Continuously, Nigerian government securities, which is bonds, treasury bills, will be exempted from the CGT. Also, for pension funds that are investing pension fund assets into shares and the likes, they're also exempted from this CGT. And then in addition is that this CGT is available as an exemption whereby you have companies that are going into a relief mode, which is that they're going to go into a reinvestment mode, which is that the proceeds from the sale of these shares are going to be reinvested in the same company or in another Nigerian company within the same year of assessment. For such companies, this CGT will be deferred, so they can roll over their proceeds and everything into the new businesses. And this is an indication that really the intention of government is to use this CGT tax to promote longer term investment in the Nigerian economy, while short-term investment are sort of like, in a sense, punished by the application of this CGT. So that is something to bear into mind as we still do transactions and structures, that yes, the CGT tax, but it can be deferred whereby longer term investments are being considered. Now, before I move on, I would like to pause and let us examine the interplay between, this policy and some other policies. This amendment in terms of the rollback of the exemption on shares from CGT is coming on the heels of the expiration of the 10-year tax exemption granted to income from bonds and treasury bills. The exemption order, like we all know, expired just last month. So the income from treasury bills and other bonds, except FGM bonds, are now taxable under the CIT or CGT framework, as the case may be. Given this, it would appear that there's a double whammy on investors who now have to contend with having to pay CIT taxes on the income from treasury bills, and also CGT on the sale of corporate bonds and on shares in Nigerian companies. Well, and I think it's as we keep talking to different either investor groups or clients, or generally companies in the economy, we begin to get a sense of what the speculations and what the worries and the issues are. And I must mention that there are speculations that these changes may have longer-term, significant, and dire effects on the capital market. And this includes, people have talked about the risk of losing the diversity of the capital market, impact of these changes on the viability of some investments into instruments like corporate bonds, and also the effect of these changes on the continued inflow of foreign investments into Nigeria, which we all know is a key source of foreign exchange. Also, we are aware that for some investor groups, that even the implementation of the CGT taxation is an issue, especially foreign investors. And this is in terms of what expenses will be admissible as deductible against the chargeable gains before you now before you now apply CGT tax at 10%. And the major issue has to do with FX losses that a number of foreign investors said they have actually suffered on account of the Naira devaluation. And suddenly some of a significant part of the investment in Nigeria in dollar terms are no longer profitable and they are recording losses. But you look at the Naira terms and you're saying there's a gain on which you have to pay CG tax, which just seems counterintuitive. So these are some of the issues that are coming out from this exemption order. And it's to mention that this implementation is definitely fraught with these issues. And there's also, in addition to this, there's also the strong indications that the FRS may be appointing capital market operators like stockbrokers, portfolio managers who actually handle the clients, disposals of these shares. They might be appointing them as agents of the government for the collection and remittance of CGT due on such disposals. And would know what this means, which means if it's not been properly done or some disposals, CGT was not calculated properly, you may be held responsible at the end of the day to make good the shortfall of such amount. So that would be a very big and important responsibility if it indeed comes out in that manner. So I think I'll leave this slide now. I think we spent some time dissecting, but it's probably one of the biggest issues coming from the amendment. So it was good we did that. And before we leave it, in all fairness to government too, there was some analysis done in terms of CGT rates in other countries, and that really 10% CGT in Nigeria is actually very conservative compared to some of the rates you see. UK is 15%, South Africa 18%, and so on. So I think the issue is not so much as the amount of the rate, but I think preparedness for the implementation vis-a-vis ongoing transactions and things that people have entered into, and how to then marry together with a changing fiscal regime. So as we move on to the next slide, I think we'll be focusing on the insurance sector and some of the changes that have come into this sector. I should start by mentioning that insurance sector has been one of the major beneficiaries of changes in the Annual Finance Act and the annual amendments that they have brought on. So it's not all a tale of woes when you talk about Finance Act 2021. The number of sectors have really benefited from it. And for the insurance sector, previous Finance Act actually helped them to remove a punitive tax regime that was specifically applicable to insurance companies. And what it did was eliminate it and put them on the same level playing field so that they are taxable in the same manner as other companies in the Nigerian economy. In the current Finance Act, that pace of positive reforms have also continued. Now, it was realized that when the previous Finance Act was enacted and putting them on a level playing field and all what have you, that the act somewhat overcompensated the insurance companies. So whereby for an item like minimum tax, the 0.5% or 0.25% minimum tax that is applicable on your gross turnover is applicable on all your gross turnover, including your major source of income and your subsidiary. But for non-life business of the insurance company, the application of the minimum tax was restricted to only their premium income and not other income like commission and what have you. So what this year's Finance Act did was to adjust it and says that their gross turnover for the purpose of minimum tax will be all income, premium, commission, and all other ancillary income that was made. And I think that's fair enough. The second major impact has to do with their capital requirements. This is not strictly a tax issue, but it has a tax component. We probably all know that in the last recent years, the regulator NICOM has increased capital requirement for the operators in that business. For life and non-life businesses that have 2 and 3 billion, capital requirement has been increased to 8 billion and 10 billion respectively. But it's not just the massive increase in capital that is the only issue, but the question is what constitutes capital? Unfortunately, the Insurance Act had a very narrow definition of capital, which was paid up capital. And that meant that all other components of your shareholders' fund, your share premium account, or retained earning, will not count as capital. And this meant for the insurance businesses to be able to take advantage of those pool of funds, they would have had to capitalize them by issuing bonus shares and dividends, to move those funds from retained earnings into paid up capital. And that process of capitalization is what generates tax consequence, because there'll be withholding tax on issuance of dividends. There's also risk of excess dividend tax, which in total will be like 40% of whatever funds are being moved into paid up capital. We have a tax leakage of 40%, and it was massive. So the insurance industry needed a relief, and I'm happy to say that that relief has come forward. There's now an expanded or liberalized definition, essentially, of what the paid up capital will be in the Finance Act 2021, which is that all elements will be treated as, all elements will be considered as paid up capital, and that includes your share premium, your retained earnings, your contingency reserves, and any other assets or admissible asset over liabilities as the regulator may deem appropriate for that purpose. So welcome development for the industry. We'll move on now to the other set of amendments, still under the financial services industry, but I think this has to do with more of our mutual funds, collective investment schemes, and specialized products. Now, this cliche, as I like to call them, that has unit trusts, REITs, and securities lending, they've also been massive beneficiaries from the enactment of the annual Finance Act, because since the start, amendments have been made to further improve activities in that industry and clarify gray tax issues or potential tax liability areas. So when I start with unit trust, maybe a number of you may realize that, or remember that in the previous Finance Act, there was a clarification obtained in terms of, or clarification given in terms of dividend distributions by unit trust to their investors, and that such distributions will not be liable to withholding tax deduction. It was a very welcome, clarification. It put paid to the issue of whether, like traditional dividends, unit trust was supposed to be withholding taxes. It confirmed that was not, and it was very good. Now, this year has also further continued on positive clarifications, and this time in the case of the unit trusts themselves. And it's to the effect that interest income that the unit trust earns, like from fixed placements, which is liable to tax on, like, maybe bonds and the other ones, interest income from fixed placement, that the withholding tax that was deducted on that interest income will be the final tax. So that interest income is no longer liable to a further tax of corporate income tax. And I think with this, I dare say probably over 90%, probably like 99% of the tax issues for unit trust have now been resolved. And I think the operators in the industry, their association, fund managers association, their regulators can now relax and look forward to a future with certainty, because over the last many years, FRS had been threatening to begin to tax those incomes that unit trust, the managers were making in their hands, that because there was no express exemption of the taxes, for the express exemption of those income from taxes and the tax law. So these amendments were very positive. The next set of collective instruments you should look at is REITs. And REITs also, like I said, major beneficiary. In the previous Finance Act, there was clarification about the tax transparent treatment of REIT instruments, such that the income, the rental and sales income generated by those REITs are not taxable in the hands of the REIT itself, but will be taxable in the hands of their investors when it is distributed to them. Of course, certain conditions were placed around it. At least 75% of their income must have been distributed within the same year of assessment and what have you. But that clarity was given. Now, after that went into place, it was realized that the Finance Act, the previous Finance Act, mentioned REITs that were set up as companies. Now, SEC rules allow for a REIT to be set up either as a company or as a trust. So technically, the issue about REIT set up as trust was not covered. And so it was important for this year's Finance Act to clarify that clarity of tax transparent treatment does not only apply to REICOs, like we call REIT set up as companies, but also REITs that are set up as unit trust. So again, this is just to give an expanded definition and to clarify the air in terms of the workability of these ones. So we move on now to look at the last in the triad, which is securities lending transactions. Like many of you know, securities lending, I think, is a trade that came up a few years ago. Some test trades have been done, but it has not really picked up as a product in the capital market. And part of the issues have been lack of clarity in terms of the tax treatment, whether the players will be worse off at the end of the day because the margins may be thin, and if that margin is totally eroded by tax payment you have to make, then what's the point? And so there was a concerted effort also to provide a good playing field for the securities lending, a trade. And in the previous Finance Act, there was clarity that was provided. And maybe just to step back and just give a little clarity, just for the sake of anybody that may not know. Securities lending is a case whereby someone who has idle security shares, who is called the lender, may decide to borrow it to another party who wants to trade with those shares, but with the understanding that at a given date in the future, that borrower will return those securities to the lender. However, when those shares are out being borrowed, the lender is still entitled to the corporate action on those securities, which means if dividends were declared on them, the borrower must return those dividends to the lender. So the question is, by the time dividends are being declared, the shares are in the hands of the borrower, or even in the hands of some other person the borrower has further on lent to. How does the dividends get back to the lender? And that means that the borrower will need to manufacture a compensating payment, which is then given to the lender to compensate him for the dividend. The tax laws did not have a framework to deal with compensating payments. And in the most brutal form, that compensating payment will just be seen as some income that the lender has earned, which will be liable to tax, corporate income tax at 30%. However, like we all know, withholding tax deduction on dividend is the final tax. So there needed to put a reform around it such that those compensating payments will be given the same status as the original dividend that was received by the borrower, so that no further tax will be applicable. And that is what this Finance Act 2021 has done, to say that those compensating payments will be treated as though they were dividend, and that withholding tax deducted on those dividends will be the final tax on it. So it's our hope that with these changes, activities and trading can probably actually pick up with securities lending going forward, because I don't think I'm aware of any other tax issues that are going to be affecting this industry. So with this, I think we're in a good place to move on to other industries now, because we have dealt with the major issues affecting the financial services industry. And we're looking at consumer and industrial markets. The major issue coming from this industry is the introduction of excise duty on non-alcoholic carbonated and sugar sweetened beverages, which we call SSBs. So going forward, 10 naira on every liter of these beverages will suffer an excise duty. We suffer 10 naira excise duty. Now, there are many schools of thought in terms of whether this is right or this is not. So there are those who are pro-health, who obviously delight in this, and that we all know the effects of sugar consumption in developed countries, that they have real issues around sugar consumption. We know the kind of strain it puts on public health. We know what it does in terms of promoting what is called metabolic diseases like diabetes, arthritis, and the like. So that, yes, this is a welcome development. Even WHO Health Organization supports, the raising of taxes on such things to discourage consumption of sugar. So that's one school of thought. But the other school of thought is that sugar is not a problem in Nigeria. So we don't have the problem. And why do you want to put a tax on it, on an industry that is still growing and that still requires more consumption of its products? That obviously the taxes will lead to a reduction in consumption. Reduction leads to a reduction in productivity of the industry, which will shrink it, can eventually lead to some layoffs or what have you, assuming those costs cannot be passed on to the final consumer. And that at a point in time whereby the real sectors of the economy actually need incentives to grow, this can be counterproductive. I think this conflicting or two sides of schools is still being evaluated. And it's not unlikely that in subsequent amendments to the Finance Act, there might be further modifications around this. I don't know which way it will go. But I think what is important for us to know as at now is that there's excise duties on sugar sweetened beverages, and that practice is similar to what is done in so many other countries the worldwide. So it is not a practice that came out of the blue. So on that note, I think we can go to the next. This is the single major one for the consumer markets industry. So I think we are free to proceed to the next sector. Are we there? Yes, the oil and gas sector. Now, this is an interesting industry. I remember during the beginning, I heard Ibuku talk about, you had sessions last year, given the Petroleum Industry Act and what have you. I think these changes are also coming on the heels of that the regulatory and tax framework of that industry is changing. And there was a need to relook also in terms of how taxes will be going forward. And as a way of background, under the PPT, Petroleum Profit Tax, it's a high tax rate at 85%. So it was deemed that with such tax rate, all other income streams or distributions in the industry should not suffer tax. That's the major headroom in which when the income is earned, 85% is more than enough. So as a result of that, when energy companies, upstream companies distribute dividends to their shareholders, it's not subjected to withholding tax or what have you. No further tax occurs on it. Now, under the PI regime and all that's happened, those regimes have been relooked. And going forward, it has been said that dividends distribution will now be liable to tax, which is withholding tax, and that will be the final tax on it. It's also been said that exports by this sector, which ordinarily export proceeds are not liable to tax, but for the sector, any of the export proceeds will be liable to income tax, again, to bring in, so they are no longer exempted from, the export are no longer exempted for taxes. And that for the small companies that exist in the upstream sector, who ordinarily under the CIT framework, maybe because they are small and their turnover is 25 million or less, so they should actually be exempted from VAT registration and other things, that they are no longer exempted. So if you're an upstream company, and even though you are small inside, you are still required to register for VAT and file accordingly. I guess the reason for that generally is that it's a very important sector, and they can use this upstream sector companies, even though they are small, to track activities in that sector and avoid that and ensure that there's little tax leakages as much as possible. So we expect that the impact of these changes on the sector is that going forward, yes, there's going to be more reporting and there's going to be higher tax costs that will be recovered by the government from this sector. So we move on to the next sector. If we are there, the digital services sector, which is digital economy. And this is largely looking at non-resident companies that provide digital services into Nigeria. And maybe I should backtrack and remind us a bit about last year's Finance Act, whereby there was, I believe it was last year or this year before then, whereby there were pronouncements around non-resident companies that have significant economic presence in the Nigerian economy. And they are seen as those companies that make 25 million and above as turnover from Nigeria. And the requirement was that such companies will need to file and pay taxes on the income they earn from Nigeria. So it was at their discretion to, or rather not at their discretion, but it was for them to submit their tax returns and then for the tax authorities to accept it. Subsequently, the tax authorities realized that many of these companies will simply claim that they are making losses from Nigeria. How do you validate it? What instruments and what provisions do you have to be able to interrogate these things? So it was thought in their wisdom to return back to their old habits of deeming profits and subjecting people to a notional tax rate. So as a result of that, the Finance Act 2021 has now empowered FRS to assess non-resident companies to CIT tax on a deemed profit or deemed turnover basis. Again, in previous past, FRS had typically used 6% of turnover as a deemed tax basis. And the basis of that is that 20% of your turnover is deemed to be your profit. And then when you apply 30% tax on the 20% profit, you get a 6% rate. Now, this Finance Act has not specified a particular rate, but we will not be surprised if it comes back to 6% of turnover. We know FRS is preparing some circulars in support of the Finance Act, and we would not be surprised if a 6% of turnover tax is not specified. So we expect that these digital players, the Amazon, Netflix, and the rest of them will now start paying taxes in Nigeria. The second thing that has happened is that the significant economy presence order, which was released like 2 years ago, has been codified into law, so that it gives us the highest powers that is required. So it's not just a regulation, but it's now an act of law. And then the third thing is in terms of still on these non-resident, particularly digital players, is to give them higher responsibilities in terms of VAT collection. So FRS has, or powers have been given to FRS in the Finance Act to appoint persons, including non-residents, as agents for the purpose of collection of VAT. And I can explain where that is coming from. Again, from the previous Finance Act, we saw a situation whereby non-resident companies who supply taxable goods and services into Nigeria were asked to register and file VAT returns, but they were not collecting it. So the VAT was to be collected by the party to which they were rendering services to, and that party will remit it over to the tax authorities. Now, that is something easily done where that party is a corporate entity. But imagine when you have individuals as the other party, individuals don't file VAT returns. So FRA saw a big loophole there and said, for that purpose, we can appoint these digital services providers, the Amazons and the rest of them, to start collecting VAT. So going forward, we should, and people have confirmed it, that they started seeing when you do transactions with these guys, that they include Nigerian VAT of 7.5% on those transactions. And the whole idea is they collect it and remit it over to the tax authorities. So essentially for this digital economy space, it has been in terms of making more revenues from them. And it's not unusual because for many economies, that is what they do. Those digital players, they are not brick and mortar shops, and they're able to trade in your country without any physical presence. And it's only fair that the economy can make a due share of taxes from actually the profits that they generate from the jurisdiction and territory of Nigeria. We quickly move over to, I think, the last specific economy sector we look at before we look at some other general amendments. And this case, we are looking at education sector. I guess it's no longer news. Educational institutions are now liable to CIT on their profits. And this is except where such a company is of a public character. That is our reading of the Finance Act. But I guess FRA is holding a view that all educational institutions, whether of a public character or not, are liable to CIT. So it's now left for taxpayers to be able to go up and actually challenge that kind of assertion. But I guess with this now, we would expect some effect from this. We'd expect that either if that taxes can be passed on to their students, then we expect it in higher school fees. And if it's not passed on, reduced profitability and probably some shutdown of some institutions who may feel they are not profitable. But it's left to be seen on how the industry will take this up and address the issue. We'll now go on to assess a few other generic ones that are general to all industries, so there was no need for us to put them together in a single bucket. So quickly, there's going to be going forward restriction of capital allowances that is claimable from a company that generates significant exempt income from its turnover. So if the exempt income, that is income from instruments like FGN bonds, if your exempt income exceeds 20% of your turnover, the capital allowances you are able to claim in a year will be restricted by that percentage that your exempt income bears to your total income. So that's to note, and that means companies need some tax planning around that so that they just don't forfeit their capital allowances just like that. The next has to do with the education tax. Now that has been increased from 2% of the assessable profit to 2.5%. We also have the introduction or the enforcement of the NASENI levy. NASENI is the National Agency for Science and Engineering Infrastructure levy, which is now 0.25% of PBT, applicable to companies that have turnover of 100 million and above. And such companies include those that operate in, mobile telecommunications, ICT, marine, oil and gas, and banking. Now, for many of you can say, this sounds familiar. It sounds like NIDA. It has similar profile as NIDA. The taxes are, except NIDA is 1%, but it's an overlap. Why do we need NASENI? We expect the public sector to be able to, or private sector to be able to go up and challenge government on this. Otherwise, we'll keep on seeing more and more levies coming up as the case may be. The other significant amendment is on minimum tax. Many of you may know there was minimum tax, reduced rate of minimum tax, which the last Finance Act introduced, but there was challenges in terms of which period it was applicable to. With this new Finance Act, further clarifications have been obtained, and then it has been expanded to include an additional year so that companies can claim 2 years of reduced minimum tax, either for 2020 and 2021 year of assessment or for 2021 and 2022 year of assessment, giving companies more flexibility and helping to uphold those COVID-19 palliatives that the government actually gave to taxpayers. So this is also very welcome. The last two sets of general amendments, which we see on the next slide, have to do with allowable PIT deductions for people who have life insurance policies. Like we currently know, under what was supposed to be the traditional regime, is that if you have life insurance policies and they are commingled with investments, maybe some investment arrangement, the entire premium that you pay over to the insurance company is tax exempt for individuals. However, with the amendment that has come on, only the portion of that premium that relates to your life policy, any investment component is no longer tax deductible. Well, the insurance industry is not happy about this. They feel it might cause some shrinkage, and at a point whereby all hands should be on deck to actually increase insurance penetration, because Nigeria has one of the lowest insurance penetration in the world at 0.3%. And at a point where such should be expanded, you probably will give a number of policyholders a reason not to go on with life insurance policies on account of this. So I think insurance companies are still going to have ongoing further discussions with the authorities in relation to this. Automated tax administration. Going forward, FRS can deploy its own tax and technology tools to extract data from clients or from taxpayers, tax systems or their financial systems, their ERPs. That's the long and short of this. It was introduced last year, but there were issues in terms of the powers were not broad or expansive enough. And so this year, the powers, FRS was giving more powers towards it. And then a penalty regime was also introduced that if you deny FRS the right to actually access your electronic systems to extract tax impacted transactions so that they can validate the accuracy of your VAT and withholding tax deductions, you have a penalty regime of 25,000 naira accruing daily on failure to give access. So we believe FRS is going to go out full force now that they've been fully empowered, with the right and also with the right penalty regime to enforce this. So taxpayers, especially those who deal with large retail transactions or customers like those in e-commerce business, banks that have large transactions, those are the targets that FRS is looking at. So they need to get ready and take note of that. So I think with this, we've come to the end of the amendments. These are the key amendments in the Finance Act that affect different sectors and affect all companies in general that we've gone through. We'll now spend the last few minutes looking at some of our concluding thoughts. And in this regard, we have a message for action points that you, our audience, who can either be business managers managing your companies, either in the finance function, treasury, or the rest, or your financial analyst advising clients, some of the things you need to take note of, moving forward in terms of this. And to start with the one on the left-hand side for financial analysts. So as advisors, we think you need to start reassessing and, some of the financial and structuring models that have been deployed, for the different advisory work we have done, due diligence, M&A, and advisory, and that in the light of these changes, especially for ongoing or recently concluded transactions that are still somewhat live, that for this, we may have to reevaluate them and change them because of the new tax changes we are seeing, because some of your assumptions and principles are no longer tenable. One of the popular things is considering debts as an investment, equity, debts rather than equity as investment, because debt had, especially with a lot of debt instruments or with even equity, that the manner in which you use them, we have to start reevaluating them so that they make more sense going forward. And then for portfolio managers, who manage clients with their investment shares and what have you, stockbrokers and the rest of you, there's a need to also evaluate also the investment strategies on those portfolios and begin to sensitize your customers. It's been publicly said, but believe you me, many customers are not taking heed. And remember that you may be appointed as agents of government going forward on the collection. You need to start sensitizing your customers in terms of this new development, and then keeping proper records of shares when they bought them, the acquisition, the cost, and then all the acquisition costs, disposal costs, such that when they have, if they make disposals that exceed 100 million in any 12-month calendar, they can properly prepare their tax returns and manage the exposure by ensuring that all admissible expenses are properly taken cognizance of, before arriving at the income that is liable to the CGT at 10%. So that's a big responsibility. And in all of this, obviously seek advice from professional advisors who are subject matter experts on this. And we'll be very happy to support you and your clients, that will need help in this. Then going on to your role as business managers managing businesses, obviously you need to advise your companies, whether you're in finance, treasury, or you're not directly there, but you have to advise those in charge of it. There's a need to conduct operational risk assessment of your policy systems, procedures, control environment in terms of these new changes to ensure that everything can be optimized, to take cognizance of the effect of these changes so that you're not caught off guard and only subsequently down the line, you start seeing unforeseen tax exposures occurring. We've seen instances of that, Also, you need to establish, an elaborate system to track, especially for your capital allowances. If you have significant exempt income, like we earlier said, once your exempt income is more than 20% of your total income, then your capital allowances you can claim as a relief against your profits is going to be restricted. by the same pro rata basis. But they are planning around the venues you can use to ensure that you don't just forfeit your capital allowances like that. So that needs some conscious planning. And of course, do make adequate provisions. We now have Naseni levy, or I didn't mention Petroleum Trust Fund, but that has been around. I think that is at 0.005% of your net profit. But the clarification this says that FRS can now collect it. So all this has to be properly noted and appropriately charged as the case may be, so that you are not left with the exposures. So our last slide as we wrap up will now be what our final word is on the issue of our final word on the issue of the tax implications of the Finance Act, and what it then means for you as tax implications, and what it then means for the economy and generally. And just to as we've put there, that the Finance Act, we know that has introduced a lot of changes, and to be honest, there's been quite a laudable, and a lot of those changes are also long awaited. Several industries have benefited from it: insurance, those in collective mutual funds as well. They have benefited significantly from it. And if you look at the track record over the last 3 years from Finance Act 2029, there's been significant positive impacts that have actually positively impacted the economy. Also, when we look at the issue of our tax to GDP ratio, which is 6%, is one of the lowest as we have it. I think some of the statistics out there in terms of how other countries have it shows that they are far higher than us. Ghana even has a higher one, maybe almost 12%, South Africa almost 20%. So we are really doing poorly in terms of our tax to GDP ratio. And some of these additional taxes, particularly tax on digital services, will help to boost our tax to GDP ratio and generate much needed domestic revenue generation, and put us at a comparative level to other nations, even those in Africa as well. So given that, we do understand that the Finance Act this 2021 may have some not only positive, has negatives, especially tax on CGT and some other things that, it depends on how you look at it, excise duties, debatable and what have you. But we believe that with subsequent Finance Act, any subsequent Finance Act can be used to correct or moderate any major shortcomings or intended consequences. So the chance is not lost in terms of, our ability to still make changes to the finance and using the subsequent Finance Act to correct any unintended consequence. So what our prognosis, or what we feel persuaded to believe, that in the long run, the positives in this FA 2021 will outweigh the shortcomings, and that the FA 2021 actually continues in the tradition of the previous Finance Act and will likely give the economy a boost. Therefore, our conclusion is that this Finance Act is likely to be a tailwind, in terms of its ability to propel the economy further into growth and sustainability in the coming years. So on that note, I would like to wrap up the presentation and say thank you very much for the opportunity to have spoken to you all on the tax implications of the Finance Act for the various businesses in Nigeria, and whether it is a tailwind or a headwind for the economy. Thank you very much.
Thank you so very much, Nike. Laura? We should soon begin the question and answer session. And if you have any questions, please type it into the chat box. And also, you can also raise your hand to ask the speaker any questions.
Thank you very much.
Laura, over to you.
Thank you so much. And thank you very much, Nika, for that. It was very interesting. I think I picked up quite a few things, and I'm happy to see that there are so many questions in the chat box, and I can see a few hands up as well. A few things that stuck out for me, I think, first of all, the fact that there is now CGT on equities. I think that's something that we all have to think about for our clients. We all have to be cognizant of the fact that there is also, in the mutual fund industry, there's been some changes as well in the tax regime. I learned about digital taxes as well, the fact that companies that are not resident in Nigeria now are potentially subject to tax. And I think I'll start the question with one in the chat box, and then I'll go to somebody who has their hand up, and we just alternate that way. So I'll start with a question from Olivia. She said, for digital companies who are not resident in Nigeria, how do we assess the actual revenue that they generate from Nigeria? or does FIRS accept whatever revenue figure they present?
Okay, thank you very much for that. And recently I was having some conversation with banks and because this was also an issue, and the banks were actually worried that maybe when these non-residents do not declare everything, they might be held accountable, because many of these transactions, remember, they are done with bank cards. So if it's a Nigerian issued cards, FRS can easily go to those banks to sort of like get counter records to confirm whether the revenues that are being declared by these non-resident entities is complete or not. So I think that's one of the ways that FRS will use to serve as a check and balance, go to the banks, get their records in terms of transactions that have been done for Amazon, add it up across all banking institutions, and have a fair idea of what they're expecting. So because of time, I think I'll just try to keep them all short, except more clarity is required.
That's fine. I mean, a comment in the chat as well from El that says that these companies mostly use payment platforms to collect their payments as well. So perhaps this also alludes to the point you made. Harrison Omeke has his hand up. Maybe he'll take his question and then I'll go back to the chat. Harrison, can he be unmuted? Although he did drop a question in the chat, so maybe I'll just read that.
Okay, yeah. I think I can speak now, right?
Yes,
Thank you for the floor. All right, so I already asked a question, but I want her to clarify. Thank you, the presenter, for a good presentation. I want to get a clarification on the impact of this whether it is restriction or actually removal of capital allowance on the profits of businesses. So we know that small businesses that do not small businesses, like as IFRS titled them or classified them, those that earn revenue of 25 million or below are not to pay tax. So the Finance Act 2021 came out to say that such businesses, the capital allowances will also be forfeited because they are not paying tax. And then those that are paying 20% or so, capital allowance will also be restricted and something like that. So I want her to clarify on what if we are looking at the impact analysis on that. We are saying it that it's even better for a small business to be paying tax in order to just enjoy that capital allowance, for example, because if you allow all my capital allowance to be eroded like that because I'm not paying tax, it means that I don't think it's a good idea, right? And then secondly, what is the practical, really? How practical is this proration of capital allowance? Your capital allowance will be restricted. I think when I read the Finance Act, it's saying the qualifying capital expenditure itself is what is supposed to be prorated. Also, and so just around those areas, if you can just give a clarification.
Okay. Thank you very much, Harrison. Let me try to quickly address the issue, starting with capital allowances for small businesses that we forfeit it. I think it's the general principle of the case, which is that if your profits have been exempted, if your profits have been exempted from tax, then that means that it's assumed you have utilized. Okay, I think that's interference has gone off. So that if your capital allowance, if your profits have been exempted from tax, so that means the assumption is that you've also utilized all reliefs. It would be assumed you've utilized all reliefs, because if you are still claiming a relief and you are not taxed, technically you're asking that government is owing you money, because you're going to say, I have something I've not fulfilled. So I don't think there is a challenge if small companies who are not paying taxes are also considered to have simply consumed their capital allowances, because it goes in tandem. Now, for other companies who have exempt income that exceeds 20% of their turnover, and they are being told to restrict capital allowances to the tune of the proportion of the exempt income, maybe it's a little bit of a different situation, and I'll explain why. For many companies, they would explain to you that my exempt income is being generated without me really sweating my assets. It's not as a result of me having 20 branches all over the places that I'm generating exempt income. The activities that leads to it is just a lean team. So my expenses directly attributable to the exempt income is narrow. So maybe capital allowances, denying you of capital allowances, which probably has been used to generate your other income and not exempt income, might seem unfair. And which is why we believe that for such companies, there needs to be further tax planning to interrogate in terms of their qualifying capital expenditure, the way in which capital allowances is being claimed, to ensure that as much as possible, they can shield those capital allowances from being restricted for that purpose. So I hope that helps to clarify. Over to you, Laura.
Thank you. When you were speaking, Nika, in your presentation, you talked about the fact that FIRS may require that companies grant access to them, like to inspect, I would imagine. And so this question from Muhyiddin saying, by granting access to FIRS, what does that imply? Does it mean that FIRS should have unreserved access to the company's site?
Okay. First of all, I think we can state that the tax laws actually gives FIRS powers to your records for as many of your records as they may require. So if they're doing an audit, like you typically know, they can ask you for any of your financial records. They can ask you for your board of directors meetings to understand what has been discussed, to try to see whether some fake tax planning was being done along the way. So they have powers to ask for records. Now, I think what we are talking about now is electronic access, because these days we just don't keep our books in, in hard copies. We have electronic systems, and FIRS to data don't have access to it. So the only records they get is what we print out or what we send them. So with this now, they can directly plug into your ERPs and extract information. They'll probably tell you the kind of format or configuration you need to also put things, so that their own programming softwares can extract the data, and then they can use that to, it's almost like you are testing transactions at source, as opposed to after the fact, you now send data to FIRS. But as your data is going on, they will be also double checking, and they'll be sure that, oh, these transactions, you are properly charged VAT. So since you've charged VAT, I'm expecting you to remit X amount of VAT to me at the end of the month. And then when you remit a lower amount, they have the records and they'll come back and demand from you the excess one. So, well, do we like it? No, we don't like it. But again, we have to be mindful of the direction in which the whole world is going to. What they are practicing is what we've seen in developed countries, because gone are the days that tax audits are simply a case of physical documentation review. Most things are being done electronically these days. So it's the direction of the future. And I think the earlier we actually organize ourselves, organize our softwares, carry out proper tax sensitization, because that's where we see there is a major issue for companies. Most of their softwares are not properly configured for taxes. So when FIRS plugs into it, leakages that had not even been detected in physical audits will suddenly be thrown up by these electronic audits. And you suddenly find yourself having exposure, even for years that have been audited. If they decide to check those records, they probably will see liabilities you haven't paid. So this is the time to do proper tax sensitization, engage the right consultants advisors that can help you, those with the right skills, and ensure you are ready, such that when FIRS knocks on your doorsteps, in manner of speaking, and asks to plug their systems to yours, you can sleep well at night without expecting any surprises.
Thank you. And how far back can they ask for records, just for my knowledge?
Well, from the law, 6 years. After 6 years, it's except there's an indication of fraud and the investigation. Otherwise, 6 years is the statute of limitation.
Harrison still has his hand up. I don't know if it's the same question from before, if you have another question.
Okay. Yes, thank you for another opportunity. Thank you for your answer. I just wanted to get this clarification on this capital allowance. Like, first of all, let's say a company just started, right? And for the beginning parts of the life of that company, it's making small profits, it's earning small revenue. So at that point, your capital allowances are huge, because you just bought the equipment, you just started production and everything. So you're making revenue that is below 25 million naira. So it's expected that your capital allowances are much then, and you're forfeiting them. So 5 years along the line, you've fully utilized all the, you fully not utilized, you fully forfeited all the capital allowances, and then you are now a big company that is making profit. You know, your profit will be quite high because you don't have capital allowance anymore to claim. So do you think that small businesses should fight that, or they should argue around that, because it's actually a disincentive to the way the whole thing is going. It's actually a disincentive because you're telling small businesses that are just starting not to utilize their capital allowance when it is actually at the biggest part of it. And then when they have now become a big company, they don't have capital allowance anymore to utilize, just because they have been exempted from a small profit.
Thank you, Harrison.
Okay, thank you very much, Harrison, and thank you for the further clarification. Actually, what I'd like to say is that those kind of businesses are not the type that were intended for this, because they are technically not small businesses. They have huge investments. It's just that in their earlier years, probably they haven't started trading. Like even people in real estate that you can use billions to construct, you know, and they don't make profits maybe in your early years until you eventually sell out your units or you rent them out, and then the cash flows then starts, and that might take a few years. So if those kind of businesses are being caught in the trap of what is small businesses, I would agree that that needs a special focus, and it's not and those are the kind of things we also like to hear about. We can support such kind of businesses or their sectors, as the case may be, in bringing this to the attention of the relevant authorities and seeing that subsequent finance acts can also address it. At least we've seen the indication of fiscal discipline on the part of our regulators and on the part of the government in this annual issuance. And they've also used it to correct errors from past, like I mentioned, along the line, like for insurance companies, they overcompensated them, you know. So they've done a lot of things around it. So this is not unusual that these are the kind of issues that can be taken back, because they are not actually small businesses. It's just that they just make small revenues in the early years of their operations. So please consider that yourself or your subsector. We will be happy to have further discussions with you and see how maybe in subsequent finance acts, such issues can be tabled and addressed accordingly.
Thank you very much. And thank you, Harrison. I'll take a few questions from the chat. One from Oluwabumi. For shares disposal, how will the 12-month period be determined for CGT purposes?
Now, that is one of the big and tricky questions, because the law said any 12 consecutive months, not your calendar year or your year of assessment, January to December. And so that means any way you look at it, if you make a disposal, for instance, in June, so from June of the previous or July of the previous year to the June of this year, they can track it, you know, or from the June when you made it to the July of the subsequent year. So there's a bit of fluidity around the implementation of that. We're aware that FRS is also coming out with its circulars to give further clarity on the manner in which it's going to implement the provisions of the Finance Act 2021. So we hope with those circulars, we'll be able to get, you know, clarity, because I think leaving it too open-ended is going to be too disruptive for businesses and for investors as well. So we hope we get clarity in it. And if FRS's clarification is also still not favorable, there's still, I believe, as private sector, we should push back, bring those issues to their attention. Regular stakeholders meetings are being held, find every avenue to raise focus and attention to this, and then let's see how we can be resolved. But right now, the Finance Act simply says any 12 consecutive months, which is a bit fluid.
Okay. And we have a question from Soluade. How will an educational institution established as a sole proprietorship file CIT with FIRS? So schools organized as sole proprietorships, how will they remit their CIT to FIRS?
Okay, thanks for that. And I'm not too close to educational sector, and I was reflecting whether can you indeed have an educational institution that is a sole proprietorship? For a minute, let's assume it's possible, because for you to ask it, I guess it's possible. Sole proprietors remit their taxes to the state tax authority in which they reside. So in which case, it is not to FRS, you would have to remit those taxes, but it's going to be to your state tax authority. And I'm trying to remember now, I think a similar amendment in terms of, or one would have to check whether a similar amendment was made to Peter that's personal income tax in respect to educational institutions. If for any reason a similar amendment was not made, that means that educational institutions under Peter will still remain tax exempt until that is adjusted. So that can be a smart tax planning in the time being until such loophole is closed up.
Another one, and then I'll take a few from the hands up. From Amina, can we really tax Amazon for goods sold to Nigeria? If yes, what about other companies that export goods into Nigeria? If you have a company in China, for example, that sells lots of goods into Nigeria, can we also tax them in the same way? And this is probably following them from the digital economy tax that you spoke about.
Yeah. Okay. Well, I think the Amazon one, we've sort of like settled it. Yes, you can tax them, and then using channels of payment service providers and banks. So FRS can obtain some local records of their transactions and estimate total turnover and then demand appropriate taxes from them. The law was specifically made in respect of the digital economy because the other side of there being a lot of data is that the tax authorities also have data that's suddenly available to them. Being digital, using those tools also means that those data can be available to tax authorities to track it. But in the case of the guy from China who brings goods here and sells them, so he's also making a profit in Nigerian environment. If he doesn't have a physical presence here, he doesn't have a company through which he's doing business here, you might say he's escaped the tax net. Now, it doesn't mean what he's doing is right, but well, maybe there's no way to be caught, so he's lucky to have escaped it, so to speak, for the time being. Because again, we have Nigerian companies who are duly set up here, and they're either not paying taxes or they're just not paying the right taxes. So that's what we call tax evasion, and that is actually a crime. We don't encourage clients to practice evasion. Avoidance, which is tax planning, also have to be done with a sense of morality, because I think we all agree that we have a common responsibility to develop our nation. If you live elsewhere in other parts of the world, you pay your taxes. Tax to GDP ratio is very high in other countries. And the only reason why they have that is because people do pay taxes, whether it's direct or indirect, and that is being used to develop the economy. So in a sense, we have a responsibility to pay the right taxes, and then we can hold our leaders accountable for the manner in which these taxes are being, or those resources are being expended for the good of the economy. So please, we can still, tax avoidance is still good, but tax evasion is not the way to go.
Thank you. I'll take a question from Olayinka, then go back to the chat.
Okay.
All right. Good morning, everyone. So I work in a digital marketing agency. So we've had the challenge of, and the confusion of whether we are going to withhold tax on payments that we make to Google and Facebook. So I want to find out if before the Finance Act started coming out, did we have a responsibility to withhold tax from the payment to those platforms, or is after the Finance Act started coming out that the responsibility is now there? And also there's a problem with Facebook, for example, because we only pay them via our debit dollar card. So we don't even pay like a bank transfer. So I want to know whether we have a responsibility to withhold tax from that payment. Thank you.
Which tax are you talking about now? Or who provides
withholding tax?
Tax?
Yes. For example, my client says, put an ad for me, for us on Google website, maybe on the search engine, and we do that. The client pays us, then we are supposed to now pay Google their own. And by the way, Google has a Naira account that we pay to, right? So my question is, whether before the finance started coming out or after it started coming out, are we supposed to withhold tax from that payment that we make to Google? Bearing in mind that they are not here in Nigeria, they are based in Ireland, right? The company, the one we work with, are based in Ireland. Then they have a Naira account that we pay Naira to. But in the case of Facebook, they also can charge on our card that is Naira dominated. They also have payment that we make via our card in the USD dominated account. So if you can just help clarify this area, please.
Okay, I'll try to attempt, but probably the details of this may need to be examined and get proper documented advice with proper review. But to start with, before the Finance Act, or before these three eras of Finance Act, before we defined what a significant economic presence was and rules around that, for a non-resident company to be liable to tax in Nigeria, he must have met some rules around, you either have your fiscal presence here, you have your employees who come into Nigeria to do business and what have you. And for all these digital companies, they didn't have any physical presence whatsoever in Nigeria. So they were not liable to tax. Let's just put it that way. Simply, they were not liable. Withholding tax is meant to be an advance payment of tax or final tax in the case of some income streams like interests, royalties, and what have you. So if you're not liable to corporate income tax, then you're not liable to withholding tax on the fees. So you are not required to deduct withholding tax. Now, with the advent of the Finance Act and definition of significant economic presence, and that if you're and that covers digital companies providing digital services and those that earn turnover of more than 25 million. These companies clearly they earn more than 25 million, so they are caught in Nigeria's tax net, and going forward they would have to pay taxes. So do you have to withhold taxes on them? I would say yes, because they are now liable to tax in Nigeria. So in terms of the mechanics and your inability to be able to deduct it, I think that's a challenge. And sometimes we even see those things locally too. Your bank, when you earn interest income, or when your bank charges you, interest income, or when you pay interest income over to your bank, maybe for services they provide to you, technically speaking, you're supposed to withholding tax. But your bank simply deducts that interest, what have you, from your account. So you have no ability to withhold it. And in such situations, those situations have been explained to the tax authorities in the past, and they accepted it. So I think in this case also, whereby the wallet is either with Google or you don't have the access to withhold it, you have to make a clear explanation in the case of an audit, which is why I said your transactions, your documentation, you must support the fact that you are actually not in a position to have withheld. Otherwise, you have a withholding tax obligation, so to speak. I hope that helps to give you more tips on how you can take that forward.
Thank you, Nika.
Olayinka? Yeah, okay.
Thanks. Okay, there are a couple of questions in the chat that I'm going to merge. And they're really asking you to clarify a little bit more around small businesses, the impact of the tax changes in terms of WHT, VAT. They're asking you to clarify in simple economic terms how the Finance Act impacts digital small businesses, but frankly, all small businesses. It's broad, but if you can.
Yeah, I'm trying a bit to struggle, and I don't know whether it's this Finance Act or the previous Finance Act that it is, because there's like I said, there's like a continuum that has been following. And generally, Finance Act has exempted small businesses from tax. Did not start with this Finance Act. So that once you earn a turnover of 25 million or below, you're not liable to VAT, you don't need to file for it, you don't pay CIT. Of course, it raised a whole lot of issues in terms of how do you account, how do you know whether, at what time do you know whether your turnover, because when you start the year, you're not sure whether you hit 25 million at the end of the year or not. So your monthly VAT returns that you're exempted from, how do you measure it? And I think what FRS tried to do last year was to release a series of circulars, which sort of like gave clarity on how you count this, and that up to the extent within the year that you have not yet hit 25 million, those filing obligations are not yours. But the moment maybe it's in month 6 or month 7, you now hit 25 million, you then have the obligation to start on your VAT filing, withholding tax, deduction, and of course you then pay corporate income tax at the end of the year. I think just changes that came in this year is in relation to like the capital allowances that you don't claim. And like I said, the intention of that was such that if your taxes, your income is not being taxed, then you can just assume your capital allowances and all other reliefs have been consumed, because really you have been exempted from taxes. But I think the other gentleman that spoke earlier on did give an exceptional situation, which is very good. I'm happy he shared that. In the case of big companies that are technically big, but in their early years, they're not making huge turnovers. So you can categorize them as turnovers of less than 25 million. So I don't know if this has explained, or somebody can please just do me a favor and put a more specific question in the chat box, and hopefully we have the time to take it before this is all over.
Awesome, thank you. And we have a question from Abbas. He has his hand up.
I think it's still muted.
Okay. Yeah. Good morning. Thank you for the presentation. It's very, very thoughtful and it's very, very clear. I have a further clarification to make. Is very similar to the just a concluded question that you addressed, and it's just a practical form of a small business transaction that has to do with VAT. Recently, I prepared an account for a firm and for a company rather, and then I sent my invoice and added VAT. So the financial controller there returned my invoice saying that I don't have access to claim VAT because I'm a small firm. I know, and I'm making reference. I mean, it made reference to Finance Act 2020. So in such a situation, can it be sure whether I'm not going to be able to make up 25 million at the end of the year? I just wanted to use that as an example and clarify on what the previous questionnaire asked. Thank you.
Okay, thank you very much. I think questions on small businesses are very popular today, and that's interesting. Okay, first of all, the finance person, he has where it's coming from in terms of what the Finance Act said is correct. Maybe the real issue, just like we said, is first of all, how did you know that you weren't up to a 25 million naira turnover business to start with? So, and I would like to believe that maybe you have shared with him your financial statement, perhaps of the prior year before, and he does know that he really does know that you're a small business. Now, if you are not a small business, because maybe your turnover in the last year exceeded it out there about you, I think you need to share more details with him and let him know that you are registered for VAT, and you are by law required to collect VAT. Now, if it so happens that at the time you sent your invoice, you are not yet up to 25 million in that year, and historically you have not been doing up to 25 million, then it's okay. Then the obligation is his to withhold his VAT and remit it over to the tax authorities. And you can be rest assured, if an audit is conducted on your books in future, you can show that as at that period in time, that year, you are not yet up to 25 million and you didn't have the obligation. And then, like I said, if subsequently, some months down the line, your turnover year to date has indeed hit 25 million, then you have a legitimate responsibility to begin to collect VAT. So it has to be more sharing of information with your customers so that they can be comfortable that you can indeed collect the VAT. I hope that helps.
I hope so, Abba. I think a deviation from our question around.
All right, thank you so much. That's fine.
Okay. We've had a lot of questions around small businesses, etc., but this one is a bit different from Ikenna. He says, from a cybersecurity perspective, who bears the responsibility of ensuring that FIRS plugins do not create opportunities for cyber leaks? Will FIRS provide sufficient notice to ensure that all plugins are tested to ensure safety of records?
Okay, Ikenna, thank you very much for that question. And those are part of the ongoing debate also in terms of these plugins and what have you. And a lot of people are asking that FI should come out with their specification, let them know their requirements so we can even start probing further. But unfortunately, as at now, no further, okay, let me be careful. I think for some industries, I understand for the e-commerce and some large supermarkets, FRS has indeed started plugging into them. So I think there's configuration for those kind of businesses. But for the banks, for instance, and those kind of financial services industry, they haven't started doing it, and they have not provided their configuration. So until it comes out, before we do know, and then maybe any further issues can be raised with FRS. But as at now, there are no information around it.
Thank you. And I'll take a question from YouTube and then go to Ayobami. So from YouTube, we have from Doris. Please, can I get clarity on capital allowance administration for companies having taxable income and tax-exempt income?
Okay, I think that's the issue I mentioned, that if you have those two categories of income, taxable, non-taxable, the question then is, what proportion does your non-taxable income bear to your overall income? So I think right now, the only clear exempt income is FGM bonds, income from FGM bonds. So let's assume that with the nature of company you actually make 25% of your turnover from FGM bond, income from FGM bonds. So that means you've hit the threshold. And for that reason, when you calculate your capital allowances or your qualifying capital expenditure for the year, your capital allowances on those skills CE, 25% of that will be, in a sense, disallowed, and you can only go forward with 75% of those capital allowances as a relief against your taxable or your assessable profit, as the case may be. But if your exempt income does not get to the threshold of 20%, then no restrictions will be done on your claim of capital allowances. So I hope that helps to clarify that.
Thank you. So I'll have Ayobami and then we'll go back to the chat. Ayobami.
Ayobami, you can unmute yourself.
Okay. He's on.
Okay. Good morning.
Good morning.
Yeah. So my question is still on companies that are exempted from VAT. That, let me say, the startup companies that, okay, their turnover is below 25 million. So my question is this: does it mean that, okay, at the end of every month they are not expected to go to FIRS to file returns, like, okay, probably file new returns? So they just need to hold on until the end of the year. They will now do their annual return. So I just want to get it right. Does it mean monthly basis they don't need to visit FIRS at all?
Yeah, correct. If you are below 25 million, you have no tax obligation whatsoever. So you don't need to file new returns. You don't even need to register for taxes. As in, the law will not even recognize you as a taxable entity. But once you hit that threshold, then you can now register and start filing monthly VAT returns and the rest of it.
Okay, so is that applicable to company income tax as well? Does it mean that the company doesn't need to file their returns by the end of the year?
Okay. I need to be sure about this. First of all, you are not liable to CIT taxes, but I think there was a circular where FRS specified that you should still file those returns, but you are not going to be liable to tax, so that they can have a record of your activities. I think there's a requirement like that. It's not in the Finance Act, but that's part of the day-to-day, clarifications that FRS wants to use to manage taxpayers.
Oh, okay. Thank you very much.
Emnike, just for my clarity, because it lends to a question in the chat, this file you're talking about, is it filing with CAC? Because there's a question here where
it's filing with the tax authority, FIRS, Federal Inland Revenue Service, for companies.
Okay, because there's a question here that asks, a question here that asks further that even if I'm a small business, right, and I don't have to file with FIRS, am I still liable to file my annual returns with CAC? So from Oluwa Kemi, she asked whether you must still file with CAC as a small business, even if you're not subject to tax.
Okay, I'm not an expert on CAC matters, but I'm not aware of any rules around the exemption of small companies from filing CAC returns on an annual basis. But you may probably just need to confirm that from maybe your legal advisors or just to be sure around that.
Okay, thank you. I don't fully understand this question, so I hope you will. From Omolola, is the tax payable by NRC? I don't know what NRC is. Only in respect
non-resident companies.
Okay. Is the tax payable by non-resident companies only in respect of Nigerian income? And how is Nigerian income differentiated from other income in the NRC? So now that you clarify that, I feel like you've answered this question.
Yes, actually. For NRCs, you can only pay tax in Nigeria for the income you make in Nigeria. But for we Nigerian citizens, we are liable to tax on our worldwide income. So, but for NRCs who are not Nigerian residents, it's only the income they make from within Nigeria that they're accountable for the taxes. And we've explained previously in terms of how FRS can get the records, and you apply the deemed tax rate in order to tax them. So I guess I don't need to go through that again in view of time.
Sure. And then kindly confirm if CPs, commercial papers, are now taxable, considering FIRS considers treasury bills as taxable.
Commercial papers were never tax exempt. because the tax exemption was specific to bonds and treasury bills. So CPs did not have a tax exemption.
All right, thank you very much. Thank you. All right, so I think, that there are a few more questions, but I feel like we've covered a lot of them. They're really around small businesses, etc. So at this point, I will hand over to Yemi for our closing remarks because it's now 11:30. Thank you.
All right, thank you very much, Laura. Thank you.
Thank you so much, Laura. Thank you so very much, Nneka James, for a very, very insightful session. I thoroughly enjoyed the exchanges and the questions and the presentation. A lot of participants have been asking about the slides. Maybe we'll be sharing with them later on. I'd like to, on behalf of CFA Society Nigeria, the Board of Governors, the members, thank you so very much for taking time out to honor our invitation and have this session with us. I would also like to thank all participants that signed on. We actually maxed out, and some were signed on YouTube, on our YouTube channel, for sharing their time with us for this very, very insightful session. And I would like to also thank Programming Committee of CFA Society for putting this great webinar together. On that note, I would say until when we come your way again, thank you so very much. Have a lovely day, everyone. Bye.
If you've made a decision to aim for a long-term and successful finance career, taking the Chartered Financial Analyst CFA exam and studying the curriculum is an excellent way to ensure you have a strong knowledge base and top-notch skills. Are you ready to take the bold step to invest in yourself? CFA Society Nigeria is at your disposal, promoting the highest standards of investment practice in Nigeria. As an affiliate of CFA Institute, CFA Society Nigeria seeks to promote the highest standards of investment practice in Nigeria and to provide a vibrant community in which its members and other key players in the investment industry can interact and grow. When you have the CFA Charter, you're globally recognized. Take advantage today by writing the CFA exam and joining us at CFA Society Nigeria. For more information, visit us at cfasocietyn.org. CFA Society Nigeria, making finance a force for good.